Thank you so much for coming. My name is Lara Moberg. I am on the board of the Research Foundation. The CFA Institute Research Foundation is its full name. Quick bio of me. I am a co-CIO of Vivify Ventures, a private credit operation in the cannabis space. And I'm also recently a co-founder of Wealth Horizons, where we are working on really reimagining private wealth. I am a very, very proud Research Foundation board member. It's a great organization. Our mission is to advance the knowledge and the practice really of the investment community and the research by disseminating pieces. We have a lot of written pieces. You can find us online, so please, after the session, go and peruse what you find interesting. Our topics range everything that you probably are looking for, whether it's risk, asset management, market structure, behavioral finance, and a lot more. We also, as Susan mentioned, have our podcast. This is the Financial Thought Exchange. I am a co-host together with my friend and colleague, Larry Siegel. And from that podcast, you learn from the brightest minds in investment and in finance. I want to emphasize we are in the CFA Institute Research Foundation. It is an independent organization. We do not rely on corporate sponsorship so that we can remain and stay independent. So we rely on donations from people just like you, CFA charter holders. So consider giving us some love after this session. And this part of what we're doing and this session today, this workshop, is really to bridge the connection between academic theory and the practice of finance. And we want to promote dialogue. We want to see people disagree sometimes. And we chose this topic as a very good one because we hear a lot of different views on where private credit is going. And we have a publication on this topic that was published just a few months ago. And we really encourage you to pick a copy out. There will be some in the back. Now, with that, I can introduce our speakers. Now, you may have seen there are a little bit different set of speakers. We had a cancellation last minute, and we have the big hero of this session really is Alfonso, who stepped in last night. But he is not only the co-author, but also the editor of our publication, so we are in really good hands. Now, first speaker, though, will be Mark Higgins. And Mark Higgins, right here, is a senior vice president for IFA Institutional, where he provides advisory services to a variety of large institutions and select high net worth individuals. As a financial historian, which is really one of his strengths on this panel, he has written a book, Investing in, do you have one copy here?
It's over there, I got it off the stage.
We'll show you later. Investing in US Financial History, Understanding the Past to Forecast the Future. So available on Amazon and everywhere. He also serves as a member of the Museum of American Finance editorial board. Now, Alfonso Ricciardelli, to his left, has a dynamic career in alternative and macroeconomic strategy and has held numerous leadership roles in investment, advisory, asset management, and content strategy. He is currently working on an M&A advisory for European small businesses. He is, of course, a great communicator in this space. And as I mentioned, we had the publication on private credit that he worked a lot with. And if you check out the Financial Thought Exchange podcast, you find the actual first episode of that was with Alfonso, where we have a conversation about that and about the publication. And our podcast you find on YouTube, but also on everywhere else that you're listening to podcasts. So with that, one more housekeeping item is that we do have Q&A. If you go into your app, there's a function there under the session where you can ask a question. And I'll have my iPad where they pop up and we will, oh, that was product placement. I'll have a tablet where the questions will pop up and we'll get it through that way. If you're confused and you really want to ask a question, just hold up your hand and there are microphones in the back too, and they will deliver those microphones to you. So with that, Mark, take it away. This is going to be, the setup here is that both of our speakers will have short presentations, and they're reasonably short, so that will leave a lot of room for your questions and a lot of dialogue. So thank you.
All right, thank you, Lara. Well, thank you, Lara. Thank you for Alfonso for the last minute entry into this. I'm going to kick it off by just going through a couple slides for about 10 minutes. I'm not going to be able to go through them all in detail, and one thing I like to do is build slides that you can take as a takeaway as well and read through them. But I'm going to be a little probably on the more pessimistic side, although we agree more than people think. I talked to Stefan for a while last night. I talked to Alfonso and Lotta this morning. We agree conceptually. It's just what perspective you're looking at private credit from. So when I wrote Investing in U.S. Financial History, after studying about 235 years of financial history, you start seeing a lot of the same behaviors just over and over again. And I would say the most common source of mistakes that I've seen is the human instinct, the herd behavior, the human instinct to follow the herd. And, this paid off when you're on the savannah and, someone's running from a lion, you're probably better off running too. But in financial markets, it tends to lead to you're going to follow the herd and buy at the top of the market and follow the herd and sell at the bottom of the market. And I have two quotes. I'm not going to go through them in detail, but they're from different time periods. One is from Otto Kahn, who was a senior partner at Kuhn Lieb, which is a big investment bank back in the 1920s and 1930s. And he was articulating the temptation to follow the herd and why that led to the crash in 1929. And then the second one I think is actually more relevant today. It's from David Swensen, who everybody knows his name, I guess, or at least most people, was the late CIO of the Yale Investments Office. And he just described the risk of herd following. And he said, once a majority of players adopts a heretofore contrarian position, the minority view becomes the widely held perspective. Only an unusual few consistently take positions truly at odds with conventional wisdom. And this is something to keep in mind if you're thinking about a private credit allocation. And it is pretty interesting to see this applied in the 21st century. What is odd is it definitely plays out. This plays out in alternative asset classes, yet it just seems like fewer people seem to notice it. I wrote an article in Financial History magazine about 6 months ago on the cycle, the investment cycle of alternative asset classes over the past 45 years. It's called a 45-year flood. I kind of like the name of that one. But there is a distinct cycle, and what you typically see is there's a new void that opens in the capital markets, private credit. People really point to the 2008, 2009 financial crisis. Then early capital providers generate pretty exceptional returns, and then that attracts a lot of followers. And pretty soon the supply of capital is greater than the demand of capital, and the forward-looking returns look a lot worse than the backward-looking returns. This has happened in venture capital. You can see some stats to the right showing venture capital, how great returns attracted new entrants, and the returns compressed. It's happened in whaling. It's happened in a lot of different alternative asset classes, and there's some signs that it's looking like this is starting to happen if it hasn't already happened in private credit. And what this means is it just doesn't take long before the supply of capital outpaces the demand from good opportunities, and unless you're a very highly skilled investor, you're probably going to be disappointed with the outcomes. And there's a great quote from and I talk mostly from an institutional investment perspective, so pension plans, endowments, et cetera. And there's a great quote there's a book written on endowment strategies in 2008. And there's a great quote from Alan Bufford, who was the treasurer of MIT at the time. And he was just talking about how so many decisions are made based on mean variance optimization without considering the fact that you need to be very skilled in order to make the allocation worthwhile. And he said, you don't want to be average. It's not worth it. Does nothing. In fact, it's less than the public market. The question is, how do you get to first quartile? If you can't, it doesn't matter what the optimizer says. And so, the question is how is this playing out in private credit right now? And it does look like, at least from my perspective, and having seen a few of these cycles before, that we're in that flood phase where there's an oversupply of capital. And there's an interesting study by the National Bureau of Economic Research. You can get it online. It looked at 532 private debt funds from 1992 to 2015. And on a risk-adjusted basis, the conclusion was that after the fees, they're just, on average, not adding value. And the thing to keep in mind is this ended in 2015. We're 10 years after that. So if you think of that venture capital cycle where you had the monster returns and then the compressed returns, I'm worried that we're definitely in that phase. So one thing, when I wrote the two chapters on, I did it earlier in the book, but more later in the book, on the dot-com bubble and the global financial crisis, a good way to look at speculative episodes is to look at them as supply chains. And that's why they happen, really, because people are usually in one or two nodes of the supply chain, and they don't see how, as the old maid gets passed, things it of course causes some pretty big distortions. And I think this applies to alternative investments generally and private credit currently. And what I've pictured on this page is just how the supply chain works for pensions and endowments. You have the assets on the left, so the borrowers. You have the active asset managers, so the people providing private credit. And then in the middle, you have investment consultants and investment staff who are advising trustees to invest. And what people often don't appreciate is, it can be subconscious, but there are real conflicts here that a lot of investment consulting firms have really built their businesses on adding more asset classes, more complexity to the portfolio, more active managers, and investment staff have career risk. They built their careers on maybe managing a certain asset class. So it's something that you need to really keep in mind. And one thing I did just for this presentation is I looked at what the asset class assumptions look like for private credit and how they've changed over time. And what was really interesting, I used this survey called the Horizon Actuarial, by Horizon Actuarial Services. They poll 20 or so consultants and major asset management firms and get average asset class assumptions across a variety of asset classes. And what you see in this chart is the blue line is the growth in assets in private credit. And then the orange bars are the average real, this is net of inflation, real return expectation for private credit. And there are three interesting observations here. One, they're pretty late in creating these. It took a while. It wasn't until 2019 that a sufficient number of assumptions were available to analyze. Two is they lowered these are long-term assumptions, they're 20 years, but they significantly lowered them after COVID, which is kind of all else being equal, you kind of expect the opposite when things are distressed. And then, when things got a little safer in 2023 and 2024, they came back up again and at a higher level. And this seems, it's a blunt analysis, but it seems to kind of defy, if the supply of capital is going up, you would kind of expect the opposite to happen. I'm going to skip through this one really quickly because it's just rehashing the same point. I want to make sure I get through this. But I did look at it on an individual level. Who are some big allocators to private credit, and do you see a similar trend? The bottom one's a different thing I don't have time to get into, but you do see a general trend among the big allocators of the same thing. It's kind of like, dip during the distressed time, particularly with Makita, and then rise to high levels. And I think the interesting thing, 2023 to 2025 with Makita, 6.4% real return over 20 years, that's pretty high. And it seems questionable. So, the major point here, and this is where people probably think we disagree more than we do. I don't deny that there's opportunities in private credit. It's just that in my experience looking at history, having worked in investment consulting, it's that people generally overestimate the prospects. They overestimate their ability to discern very good funds from very bad funds, and that can cost them a lot in the long term. And there are a lot of people that are better off taking a pass. And there's no shame in that. But if you don't take a pass, there's a great quote. There are only a couple people that stand out in U.S. financial history. One of my favorites, I would say it's my favorite, maybe close to Alexander Hamilton. It's between her and Alexander Hamilton. Is Hetty Green, who I think I think she was the best investor in all of U.S. history. And I've written a few papers about her. But she never got caught up in the manias and just outperformed throughout the Gilded Age. She never got ruined by a panic. She was actually always in cash in a panic. And she would do due diligence like nobody else. And it's a kind of a funny quote here. It's a small scale, but she would never get caught up in a panic and could outperform because she did the opposite of what people were usually doing when they were buying and selling. And she just turned over every possible stone to figure out what was going on in a company before investing in it. So it's a good guide. I'm not going to go through the next page because I want to give time for Alfonso. But I do have some very, very simple high-level questions that if you're a trustee, you want to ask your consultants and advisors before investing in these funds. So I think that can help as a guide, as a takeaway. And just some closing thoughts. I would just emphasize that you see a lot of stats on the growth in assets in private credit. Never lose sight of the fact that is supply, not demand. Now, could it match demand? Sure, it could. But at least in my experience, where we are in this cycle, I would bet a lot of money that the supply is far in excess of the demand. That doesn't mean there aren't good opportunities out there. It means you need to jack up the due diligence in order to find them. So that's basically my prepared comments, and I'll turn it over to Alfonso. The changer's right there.
Okay, make the case why he's wrong.
No. Can you guys hear me? Oh, fantastic. Is this for my slides?
That's the quicker thing. Yeah, I guess you have to click a few times now.
Okay. So the first thing we have to get to is, what is the definition of a bubble, right? Because I think the argument is if there's a bubble in private credit. And I guess that the moment that big banks come into the market or come back into the market for direct lending, there probably is one, right? I mean, the moment that BlackRock puts it in their investor letter, there may be. I don't think there's a bubble, by the way, because I don't think there's irrational exuberance. I don't think that private credit is at this. I think it's going through a big transformation. It's becoming more mainstream for clear reasons, which is that public markets are not as attractive anymore if you're looking for alpha, right? So a lot of investors are looking at private credit because there's opportunity for alpha. And I think it's hard to argue with that. And I think it's hard to argue with that given what Mark has said as well. So let's go to allocations, right? It's a 1.7 trillion market right now, but this is direct lending, right? This is not private credit. This is this very limited amount. Private credit is a much larger asset class than this, and it's a much more differentiated asset class than this. There's also another element that I think is very interesting, which is that a lot of the new allocations are going to large market and not to lower middle market. Why? Because large asset managers, large private credit firms, like the ones we know, and I'm not going to repeat them, they invest in these big deals that have big headlines, and everybody is hearing about it, and everybody hears about PIC, and journalism works like that. But at the end of the day, a very big part of the US market is middle and lower middle market firms. And the question is there an opportunity in middle and lower middle market even amidst a massive supply of capital that goes into the upper segment, the large part of the market. I think the argument here is this one, right? So the asset class, private credit asset class, is incredibly diversified. I think probably not the right word to use, but the deals are different. They're all bespoke. And firms that are specializing in middle market, they tend to have least allocations, more demand for capital. And there's this little thing about EBITDA that I think is very interesting. So for larger deals, there is a chance that then in the covenants, EBITDA can be adjusted. For less competitive deals, EBITDA calculations are more conservative. So I think what you have to look at right now is there an opportunity for alpha in picking the right managers or in picking the right deals in private credit, rather than is private credit as an asset class overbought? And the argument on my end is, I think there is, as it should be. So if you look past the headlines, if you look past the sensationalist, journalist articles, there is still a massive amount of opportunities in this space in the United States. The question that Mark asks is this appropriate for new entrants? Well, it depends on the profile of the investor, of course. I think there's a misconception that is being portrayed that private markets are becoming like public markets, right? Firms are thinking about creating ETFs and all sorts of liquidity opportunities for investors, but the reality is this is still a fairly liquid, relatively liquid asset class. So I don't think we should fool investors into thinking that they're buying a conventional publicly traded bond. I think investors should know what they're getting into. But at the same time, it is really hard to argue that there isn't alpha in this space because a lot depends on how the underwriting happens, what are the conditions offered to the firm. And at the end of the day, in the direct lending space, there's only so many American firms that are viable, to lend money to, between $15 and $500 million. So there is a cap for sure. And it is undeniable that in the past few years, the supply has been much higher than what viable firms can absorb in terms of capital. So yes, there's an argument, but there is an even bigger argument that in choosing the right manager, there is an opportunity for alpha in the space. And I think my argument is there's an opportunity for alpha in the space as alpha in public market has factually disappeared. I mean, you're aware of the stats about public markets, right? There's S&P is what, 4 companies, 5 companies have 50%, 40%? I don't even know. Does anyone know? No? Okay, well, never mind. I guess you'll ask me. This is an argument for how diversified the space is, but I would say that this is just direct lending. I don't think this even takes into account consumer loans, which is, I think, I'd argue, the fastest growing sub-asset class in private credit. So, and I'm going to close it here with a plea to the CFA. We do not, and I think this is one of Mark's arguments as well, there seems to be, as it always happens, a passion for the last trend, which is private markets, private credit. Everyone wants to get into it. And of course, as it always happens, there will be people selling snake oil, right? But that's not us, because we're all like CFA charter holders. We don't sell snake oil. But it's very important that private market education and private credit especially, is implemented and improved by the CFA Institute precisely because manager is so important in this space. So my argument, my plea to my colleagues here and to the Research Foundation is to do more of this because the more we do and the more educated our investment professionals would be in this asset class. I think, by the way, the transition is structural. The private markets will grow for a number of reasons. There's regulatory reasons as well that I'm not going to get into. One final point I wanted to make, it's true that we are at a really interesting part of the economic cycle, right? And that, that applies to private markets as well, to private credit as well. Companies that suffer for tariffs, it's not going to be easy for them to pay their debts. But that affects every company and affects the entire market. You've seen what public equities have done in the past 3 months. Now they're back up a little bit, but it's just in the expectation that tariffs are not going to be as bad as originally thought. So I would say that the transfer to private markets, at least of part of the capital, is structural, is there to stay. And I think that warrants better education and offers more opportunity for alpha, for skilled managers. And I think I'm done.
Great. Let's have a seat and we'll have a conversation and a Q&A. So again, please submit your questions. You can do it through the app. If you really cannot find that feature, then just wave and we'll get a mic once we've gone through these priority people. And of course, you can also vote on the questions, which one is most, if it's not your own question, then you want to kind of promote it. And the most popular question by far, with many votes, is, Alfonso, where's your accent?
It's a very big mix. I've lived in France, Belgium, the UK, and the United States. But ultimately, it's undetectable. It is it? I don't know.
I know you were
Italian.
Nobody actually asked that question,
Mamma
but you were all wondering. Mamma mia. Okay, so I will ask this first question to you, Alfonso. With capital coming from more of the private wealth, the question is, you mentioned covenants. So do the quality of the deals decrease through worse covenants if you have that trend of more private wealth coming in?
It depends how sophisticated that private wealth is. No, I think the answer to this question is in one of the slides. On the coveted deals, the coveted funds, and in our industry, it works with every type of asset class, right? What macro investor doesn't want to allocate to Bridgewater, right? Everyone wants to go there. And so at the end of the day, you pay a premium for it. And that premium in this space might be evident in, let's say, more relaxed terms, I guess. But I don't want to speculate, so don't quote me on this. I think generally speaking, that is the issue. The issue is that everything goes in these few trendy companies, and there should be more research. That's why CFA should do more.
Did you have anything on that?
Well, I mean, I don't invest in private credit funds, so I can't comment on the covenants. But a couple things you just described sound like an oversupply of capital. Right? When you're talking about the premium potentially compressing because there's private wealth coming into it. There are a lot of red flags. That's one of them. The fact that there's standing room only now in this room is not a great sign. It's just a lot of red flags to me.
So a question for you then, if returns, we're going to expect returns to decrease here. So one question is, would you foresee that is coming in the form of more defaults on the loans or lower interest rate that you can extract from the loans? For Mark.
For Mark.
So, I'm sorry, can you repeat that question?
Yeah, so if we're expecting the returns to decrease,
Yeah.
would you anticipate that coming mostly from companies defaulting on the loans or from the lower yields?
I mean, all else being equal, it would probably be it would be the lower yields that I'm talking about. But you know, the other thing that, and this took reading my way to the present from 1790, is cycles take longer than people think, and we have been in a very long cycle of low defaults because we've had central bank support. That could end, and a lot of people investing today and everywhere are used to a cushion that may not be around forever. And in my experience with investment cycles, they're more like 40 to 50 years. They're not certainly not 5 or 10 years. And I do have a feeling, and I wouldn't say this lightly, I do have a feeling that we're on the cusp of a new cycle. And things could change. You know, you mentioned regulation and the growth, you know, people exiting public markets. Well, you have an administration that wants to pull regulation back. Is that going to make being public more attractive? So I think private credit, so I think long story short, I'm kind of winding around a little, I think the default could change, and whenever people get complacent, and it seems like there's some complacency with that, it could change.
So another question for you, Mark, and it might be that, yeah, go ahead. Go ahead.
So, yes, I mean, there might be a slightly higher default rate. I guess this is normal and it's cyclical. But I would say that smaller loans have 4 times less chance to default than larger loans. So again, lower and middle market, it's a way to go. And I think that is just normal for every asset class when we're at the end of the economic cycle, so to speak, and when defaults rise everywhere, they're probably going to rise in this space as well. But not in a way that sort of mimics the bubbles that we had. When we think about the word bubble, we think about 2007. This is not the case.
Yeah,
That's not where we're going.
Just one thing to clarify: I don't think it's a bubble. I think there's an oversupply of capital, is my gut. But a bubble, I mean, that's a whole nother. You know, this is not .com yet. Now, is it heading in that direction? I actually think it is, but you know, I don't think it's there yet.
Okay, so somebody who seems to be skeptical of your approach or maybe interpretation of data, I'm not sure. So since the late 90s, we've not seen returns decrease in leveraged loans. Leveraged loans and private credit are in many cases complementing each other. So why should we expect lower returns in private credit? So basically saying private credit, like we're talking about, comes together with leveraged loans, and leveraged loans have been doing fine. So why would then private credit not be doing fine?
I mean, my gut is it's just a supply and demand situation. If you have too much supply coming in and too little demand, it's going to, you know, people are going to start relaxing covenants. People are going to demand lower, you know, interest rates, so the yield would decrease. It's just a function of supply and demand. I don't know if that.
Whoever asked the question, I agree with you.
Yeah.
Who asked it? Is it in the room? Good question. Yes.
Good question.
You're right.
So for Alfonso, do you have a preference in how best to invest in private credit for private wealth clients? Evergreen or closed end?
No, I don't like evergreen. Sorry. No, it's not that I don't like it. It's great, but I think closed end because evergreen sometimes becomes a way for a firm to, like, you know, keep you on a leash for a long time. I would say I think closed end.
Gotcha. So here's a question for both of you, for Alfonso and Mark. Do you have a view of prospective private credit returns relative to equity returns?
Mark, I think you want to answer.
I mean, over the long term in general, and I'm talking from, you know, public equity market, if you invest in a broad index of equity securities at a very low cost, in the long run, my expectation would be that that would outperform this new alternative asset class that maybe, over whatever time period you want to use, maybe it's outperformed equities at some point, that has much higher fees, that has what I believe is an oversupply of capital that's becoming more oversupplied, is illiquid. I don't see how that, I would bet a lot of money, that in 30 years, it doesn't pay off like an indexed investment in equity has.
And who was the economist that said in the long run, we're all dead, right? Was it John Maynard Keynes? Okay. I think the short answer is equities in the long run will always perform very well. And so I don't think the argument is what performs better in the long run. I think you should have both in your portfolio. It's quite simple. And I think that there's an argument these days that public equities are not differentiated enough to just rely on owning an index. And I think that will probably trigger you a little bit because you like indexing. But generally speaking, I would have both in your portfolio. Of course, you have to have public equities, and I guess the question was more on what public equity is, not private equity, right? Because private equity is a whole different story, and I'm not an expert in the field to give you guys much on that. Sorry.
Yeah, no, I mean, it is what it is. I think the data is, frankly, on my side, but that, it's fine.
Always a good argument. It's on my side. So there's a question also about the impact on the fees and how that impacts alpha in this. Just as it's kind of just an encouragement for you to discuss it. That is, how many of the private credit firms actually generate alpha after fees, and also whether we think of that alpha as taking account of also the illiquidity risk that you, of course, incur there. So very open, broad question, whatever you're thinking about when you hear that.
I mean, the more layers of fees I see, the faster I want to, close my eyes and go the other way. And, I just, it's hard to justify what 1.5 and 15, the illiquidity that you're getting, the risk of choosing the right managers. Will the person who replaces you, who you don't know who they are on the investment committee, be able to do the same thing, assuming you are, which is a big assumption. There's just too many ways to go wrong, and the fees are. I don't know if I really answered that question, but the fees are just. Whenever I see high fees, there's a very, very high threshold for paying them.
I mean, I guess my question to the audience is: are you guys making the fees, or you're paying the fees? That would make my answer change.
It's very telling too.
Yeah, I mean, fees clearly decrease returns. I don't think that I need to tell you that, guys. But I guess the question goes back to what's your understanding of the concept of market efficiency, right? I mean, there has to be a price for managers that offer an alpha, and that's the price you're paying. Is it justified for every investor? I would agree with Mark that it's probably not. But I mean, there's a reason why firms that have performed well have demanded higher fees. And in this particular case with private credit, there's also you're actually the underwriting process is complex. So I think that if you think that you're going to get alpha, then you should pay the fees, right? I mean, we're all in the financial industry after all. It's the reason why we're here.
Yeah, I mean, obviously, there's a lot of work that go into avoiding stupid allocations, and the fees have to cover something. So here's completely new topic. When the next financial crisis comes, will private credit theoretically protect more on the downside? More than what is, of course, not in this question, but.
Well, I mean, it depends if they're real. Depends if you use the appraisal or what the actual value of the assets are, because will they provide an illusion of protection? Probably. But if they have to sell those assets, it'd probably be a lot less than they're reporting it. I mean, that's usually the way these things work. And this is another danger that, again, like I think we've been in a 30, 40-year cycle where it's been easy to screw up as a company and not have to pay for it. And I wonder if when that shifts, I don't see how private companies are going to offer much more protection than public companies, if not less.
Do you want me to? Okay. Look, I think that in a crisis, when it's a really big one, it doesn't matter where you are, you're not going to be safe. And more in general, I think that we have this illusion that because an asset is liquid, that we can sell it, so it makes us feel better about it. But I guess the question is, when you think that we're going through a massive crisis, so you sell that asset, at the bottom or after it had a 30% drawdown, and then that crisis just doesn't happen, and so you sold at a 30% drawdown. The problem is that human brains, and this has been demonstrated in behavioral finance multiple times, they're not really made for short-term trading. And so I think sometimes illiquidity can protect you from yourself more than anything else. That is not to say that private credit investments are not going to be hit in a crisis. Just to say that it really depends what you do about it, right? And sometimes not being able to sell it is probably a good thing, not a bad thing.
It's cheaper to pick up a book on U.S. history, or, and it's a little self-promotional, or educate yourself on behavioral finance. I think that's a cheaper alternative.
Well, you both hit on a topic that I remember was very big when private credit and equity were both just more in this, like everybody wanted into it, was why are the returns, why so many people went into it was this explanation that the illiquidity premium is negative, right? That it's actually a good thing that you don't have to update your prices of it, the appraisal issue that you hit on, and that it prevents you from touching your portfolio all the time because it's locked in. I don't know if that's still what people think. I remember that became this theme.
Well, one thing I want to add, and this may be getting a little off track, what you give up for that illiquidity is your ability to rebalance effectively. I remember when I was investing in active managers, I looked at a couple active fixed income funds that had outperformed pretty solidly, but they correlated more with equity markets. And I looked at analysis, well, if we rebalanced every month, how would it look like with what would it look like with an index fund that underperformed the fixed income managers? And it was basically, in fairness, it was break even. So it was no different. So that's something you're giving up too, is when, let's say there isn't a correlation between those two assets, you can't you can't rebalance your private credit, or if you do, you're going to take a huge haircut on it. So that's something, another thing to consider.
Rebalancing is expensive. I'm going to close with this one.
In private credit, okay, yeah.
I'm not closing quite yet. No, I'll do a couple of more questions because I knew that we have a long break. And we have so many questions. I'm not going to get to all of them, I'm sorry. But one for Alfonso about this alpha issue, and you can kind of interpret this as you want, but you can generate alpha in private market, but how do you hedge against the direction of private market if you think that the broader market is overpriced?
Broader market meaning every asset class, or the
right,
private,
probably,
or the private, or you're interpreting the
probably like
as
public
private
markets.
Yeah, good question. I think that generally speaking, you can't really think of private markets as a broader market because it's much harder to have an overview of private markets. It's so fragmented and bespoke that I think that if you're into this space, you're looking at opportunities. You're not really looking at being exposed to private credit or being exposed to private markets. You have to be an expert in that space, and you have to look at the right opportunities and invest there. So I don't know that the hedging part is really something that applies to this particular space.
So last question for Mark. Private credit has grown primarily as a result of banks withdrawing from the space. Yeah, isn't that a structural change that helps explain the rapid growth of private credit? Banks draw back, private steps in.
I don't know the details today of this, but generally my impression is still that that was true more in the early days than it is now. To me, it seems like it's more supply-driven right now, with large allocators allocating massive amounts of money to these. I mean, I forget today, I think it was Apollo just closed an $8 billion fund. My gut is, yes, and that's consistent with the asset allocation, the alternative asset class cycle, where you have a void that appears in the market. It's legitimate. People generate really good returns in the early years, and then it gets flooded. And I think that's true. I think that's the void. That now I suspect that void is smaller than the, how to measure it. It's hard to measure, but I suspect that the void is smaller than the supply at this point.
I can add to this. I think both are true. So the asset class basically started because of regulatory restrictions on banks at some point, especially capital requirements. But the expansion that we had in the past years, I would argue that it's also a factor of companies, sometimes even large companies, instead of wanting to issue publicly traded bonds, they want to have a bespoke deal, and so they would use private credit alternatives instead of issuing a public bond. So I think there's convenience on the part of the companies lately. There's a part of it is trendy in the past couple of years, but initially it is true that it was banks withdrawal because of regulatory, especially capital requirements. So that's accurate.
The one thing this isn't really a question, but I kind of felt like we've spoken a lot about the allocation today. Don't discount the skill required. It is not enough to be average.
I agree.
In this space. You have got to be top quartile and consistently top quartile at this point. And there is no shame in taking a pass. You're not gonna lose a lot of money by taking a pass. You could have some very disappointing returns if you enter this asset class without really knowing what you're doing.
So thank you so much for coming to this session. This has been a CFA Institute Research Foundation session. Check us out.
Thank you.
Speakers, thank you so much.
For more information, please visit rpc.cfainstitute.org/research-foundation.